Hi everyone, Griffin Bridgers here. Today I thought it would be helpful to dive into a distinction between two very similar things we commonly see in trusts, which are one, Crummey withdrawal rights, and two, 5x5 powers. Both of them operate around the same backbone and same tax issue, but they're deployed in different circumstances. So to start with, a Crummey withdrawal right is usually a withdrawal right given to a beneficiary, either individually or within a class of beneficiaries, that only kicks in when there's a contribution to the trust. So in that situation, the intent of the Crummey power is to qualify the donor for the gift tax annual exclusion. And that qualification is accomplished by creating a present interest, which is the requirement to have the annual exclusion to begin with, in the form of a temporary withdrawal right through which a beneficiary can take out the lesser of, one, their proportionate share of the contribution to the trust, or two, the gift tax annual exclusion of the donor or of the donor and the donor's spouse if gift splitting is elected. Contrast that with a 5x5 power, which is a right given usually to one beneficiary of a trust, which can be exercised annually, and it gives that beneficiary a way to get property, primarily principal, out of the trust without having to rely on a trustee's discretionary distribution powers. So this is a power that can be exercised regardless of fiduciary obligations, and it typically allows the beneficiary to take out the greater of $5,000 or 5% of the trust every single year. Now, with both the Crummey withdrawal right and the 5x5 power, there's a limited window in which to exercise that power. And in that situation, at least by the end of the year, if not before, that power will go away. And there's a significance to that from a gift and estate and GST tax perspective. So to start with, both of these powers are known as lifetime general powers of appointment. So the significance of any general power of appointment is it can cause the holder of that power to be treated as the owner of property for gift, estate, and GST tax purposes, even though the property is technically owned by the trust. And not only that, because this power causes that holder to be the deemed owner of the property, it means that that power cannot be gotten rid of without there being a corresponding gift, estate, or GST tax effect. So around this backbone, there's a set of principles in the tax code around the gift and estate tax rules that says if you have a lifetime general power of appointment and it goes away by an intentional release or simply by the lapse of time, there won't be any gift, estate, or GST tax effect so long as the lapse is limited to the greater of $5,000 or 5% of the pool of assets over which that withdrawal right could have been exercised. Now, with this greater of $5,000 or 5% limitation, the big difference between Crummey rights and the 5x5 power itself is that a 5x5 power is usually exercised over a much larger pool of assets. So if you have a trust that's, let's say, $1 million, then with a 5% withdrawal right, that means you can effectively take out up to $50,000 in principal every year. So in that case, that lower $5,000 limitation usually will not apply. Contrast that with a Crummey withdrawal right, where the lapse only applies to the portion of the contribution of the trust that a beneficiary could have taken out. And if that amount is limited to the annual exclusion, which is $17,000 to begin with, what that means is 5% of that $17,000 amount is going to be much lower than the $5,000 typically floor of that 5x5 lapse limitation. So most Crummey powers are going to lapse at a rate of $5,000 per year. Now, when we look at the two, there's a significance from a GST tax perspective that we have to acknowledge. And that is that if a power like a withdrawal right, whether it's a Crummey power or a 5x5 power, is held by a spouse, that creates an estate tax inclusion period. And as long as there's an estate tax inclusion period, GST exemption cannot be allocated to that trust, at least for the portion over which the spouse can exercise their withdrawal right. However, in the case of a Crummey withdrawal right held by a non-spouse, we don't have to worry about that ETIP issue because the ETIP rule only applies to a grantor or a grantor's spouse with respect to a trust. Now, when it comes to the allocation of GST exemption, even though an ETIP period keeps it from being allocated, there's a separate rule when dealing with non-spousal beneficiaries. And in that situation, a general power of appointment given to a non-spousal beneficiary could cause the trust to fail to qualify as what's known as a GST trust, meaning that no GST exemption could be automatically allocated to that trust unless it's given a GST trust election or unless there's a manual allocation of GST exemption on a gift tax return. But the good news is that under the GST trust rules, the existence of a Crummey power is carved out to say that that power will not keep a trust by itself from qualifying as a GST trust. Now, beyond that, we have to look into the significance of Crummey powers from a gift and a GST tax perspective with respect to the holder of the actual power. Now, these are going to be very confusing principles, and I'm going to really skirt over them quickly, but it's important to note first and foremost that by merely giving a Crummey power, the donor qualifies potentially for the gift tax annual exclusion and sometimes even the GST tax annual exclusion, depending on how the Crummey power is structured. But in either case, it doesn't matter whether the beneficiary actually exercises the Crummey power or lets it lapse, because that use or that grant of the gift and GST tax exclusion occurs because the holder of that Crummey power becomes the new owner of the property for gift, estate, and GST tax purposes. So what happens ultimately when that power lapses? Well, that 5x5 limitation says that as long as the lapse is limited to 5,000 or 5% of the property over which the withdrawal could have been exercised, then that lapsed portion under those thresholds won't be treated as a gift by the holder of that withdrawal power. However, in the case of a Crummey power, recall that we have typically a $5,000 lapse floor that applies, and then we have potentially an excess of $12,000 or even $29,000 when we look at the difference between that floor and the annual exclusion or double the annual exclusion that could have applied there. So there's two ways we can usually tackle that problem. One is the use of what's known as hanging powers, which says that that excess over $5,000 is left hanging as a perpetual withdrawal right that can be exercised by the beneficiary until the next year a new lapse occurs. Because what I didn't mention is that 5x5 limitation is a per year analysis. It's not just a one-time thing. You can apply it once per calendar year. So if you allow that Crummey withdrawal right to continue, then it can continue to lapse out at a rate of $5,000 per year without gift tax consequence to the beneficiary who holds the Crummey withdrawal right until ultimately it goes away. But that works well in theory with a trust where there's a one-time contribution. If you're planning on making perpetual annual exclusion gifts to the trust, that hanging power setup may not be optimal because it creates an ever-growing Crummey power, which is going to grow at a rate that exceeds the gift tax-free lapse of $5,000 per year. And eventually, that power could get so large that even that higher 5% lapse limitation could kick in when the cumulative withdrawal right exceeds $100,000. So the principle around which this exercises is that the excess over that 5,000 limitation is technically a gift by that beneficiary who holds the Crummey power to the other trust beneficiaries. So the way around this to avoid a hanging power is to instead create a trust structure that keeps the lapse from being a gift to the other trust beneficiaries. You accomplish this in two ways. One, you carve off a separate share of the trust into which that beneficiary's share of property over which the Crummey power could be exercised is held exclusively for the benefit of that one beneficiary as the sole beneficiary for life. So that keeps it, at least temporarily, from being an immediate gift to the other trust beneficiaries. But the beneficiary could have other remainder beneficiaries living or not living, and there could technically be a gift to them. So we cut that off and avoid that by also giving the beneficiary a testamentary power of appointment over their separate share trust. That power of appointment could be limited or general, but in either case, the existence of that power of appointment keeps there from being a completed gift due to the lapse of a Crummey power from that beneficiary to the other trust beneficiaries. And depending on how that separate share trust is set up, it may also qualify for the GST tax annual exclusion, which has different requirements from the gift tax annual exclusion. Now, I know this is like drinking from a fire hose and it's a lot of information, but hopefully that gives you a basic rundown and possibly even an intermediate rundown of the difference between 5x5 powers and Crummey powers. If you have any questions, you can email me at griffin.bridgers@gmail.com. But in the meantime, thanks for listening. I look forward to seeing you in my future content.